Our next and final guest garnered a reputation over many years as one of the most successful British fund managers of all time. Always wary of the dangers of a herd mentality, he once called the culture of the City of London bullshit and was unafraid to eschew tech and media stocks in the run-up to the bursting of the dot-com bubble. In the 2000s, he sold down his stakes in several banks despite their healthy dividends. While the financial crisis battered many of his peers, his flagship high-income fund at Invesco Perpetual was back on a level footing just a year or so after the fall of Lehman Brothers. Indeed, £10,000 invested in that fund back in 1988 would have been worth some £175,000 by 2011, more than double the return an investor would have received from the FTSE All-Share Index. Running funds that collectively had more than 30 billion in AUM, he was, they said, the man who made Middle England rich. But then, in 2019, and by now running his own firm, Woodford Investment Management, he suffered a serious setback when liquidity problems in one of his funds led to its collapse, leaving many investors out of pocket. Despite a long-running FCA investigation, which is expected to continue for a while, he returned to the public eye this year with the launch of Woodford Views, a platform that promises to challenge prevalent pessimistic narratives about the UK economy. We've just had a few of those. Ladies and gentlemen, please welcome Neil Woodford.
Thank you.
Now, Neil, we may as well start with the thing that's likely to be top of mind for many people here, the collapse of one of your funds and the fallout from it. And I know there's a limit to what you're able to say because of ongoing processes, but what can you say, and what should people who have perhaps followed the headlines, read the headlines, but not got to grips with the detail of what really happened, what should they understand?
Well, look, good afternoon, everybody. Yeah, and good afternoon. Thank you for having me. Yeah, it's very difficult for me to comment at length. In fact, I can't, because there is an ongoing investigation which took another step forward a few months ago. But there are some things I can say, and if you will excuse me, I'll have to read out something in a minute. But in broad terms, I mean, I think the first thing I should say about what happened was that, as you might expect, what actually happened, the truth, was an early casualty in this sort of crisis that I confronted 5 years ago, and it was incredibly painful. And I think lots of people, I've had various experiences of speaking to journalists over the period of time, not much in the last 3 or 4 years, but earlier on. And the question that came up was, are you really sorry about what happened? And it struck me, from what you said in the introductory remarks. I mean, I spent 35 years in the city delivering really good outperformance for lots of people. I was running 32 billion at Invesco, and I delivered over a long period of time pretty spectacular returns. Now, I took that very, very seriously. It was an obsession, maybe an unhealthy obsession, but it was an obsession, delivering good outcomes for my investors. So, of course I was sorry about what happened. It was awful. It was a horrendous experience to go through. And I am very sorry for what happened to the people who got locked into the fund and then ended up losing money. But it was a harrowing experience. And unfortunately, I'd very much like to tell you all now, well, this is actually what happened. This is what you may have read. That's complete and utter bullshit. This is actually what happened, but I can't. So, but there are things I can say.
Sure.
So
well, please,
if you excuse me, I'm just going to read out something that my lawyer said. Yeah, you can say that. So, hopefully this will be shed some light and will lead you to sort of understand some of the story behind the words I'm going to give you now. So. Central to the FCA's action is the accusation that I acted unreasonably by not challenging how liquidity was measured and also the parameters of what was considered an acceptable liquidity profile for the fund. And the fund they're talking about is the Woodford Equity Income Fund. So, as we made clear in our press release, I can't accept that allegation. The liquidity framework was designed by Link, the ACD of the fund. Now, Link is the nation's biggest ACD. I think they look after over 100 fund groups. They designed the framework, and they were ultimately responsible for it. Interestingly, the FCA had visibility of the implementation of that framework and did not themselves challenge it. Neither did Northern Trust, who was responsible for overseeing Link. Northern Trust was the depository of the fund. So the idea that I should have challenged how the fund's liquidity was being measured and the acceptable parameters of the fund's liquidity, when all of those organizations did not challenge it, is not realistic or reasonable. Against really tough conditions, and as you probably all know, there was a huge outflow from the fund during this period, I kept the fund within the liquidity framework. That's why I was very surprised. It's not the right word, really, but he said surprised. When Link decided to suspend the fund. And that was on June the 6th in 2019. And then pretty much 4 or 5 months later, we had to close the business, which at its peak had employed 110 people. It was a pretty traumatic experience, as you can imagine. I hope that sort of gives you a bit of a framework. That's sort of all I can say. I was going to try and do what's the guy? Forrest Gump. Sort of. That's all I want to say about that. But anyway, that's all I can say about what happened. Okay. Thank you.
Very good. Yeah. Well, thank you very much for sharing that with us and for confronting it. I mean, there are things that perhaps you can talk about in a personal sense. I mean, you said it was very difficult. Can you give us a sense of sort of the path, the journey that you've been on since that time? You know, since 2019, what you've been doing, what you've been working on, what you're feeling, what your sense of perspective now is of that time.
Yeah, look, as you can imagine, I mean, I just to give you a sense, I mean, I'm not proud of this, is just give you a sense of the sort of tumult that happened at the time. Donald Trump was visiting for the first time, I think, visiting the UK. And on the day that he visited, he was demoted in the FT to page 3 or 4. And there were 3 separate stories on what was happening to me and my business in the FT that were far more prominent than Donald Trump's visit. As you can imagine, it was absolutely horrendous. The media just get hold of you and don't let you go. And there is no court of appeal with the media. Once they've decided what they're going to say, they're going to say it. And this is something I learned. There's nothing you can do or say that will divert them from that. And that's why I said at the start of this that truth was a sort of an early casualty. So that it was horrendous. I mean, when I look back, it's hard to imagine. Well, it's hard to understand how personally I got through it, and how my family got through it, and of course I had to make 110 people redundant, which is not nice. So yeah, that was pretty horrendous. In terms of learnings, I think one of the things that I think, you know, there are a couple I think that I can talk about. First of all is that you may not know this, but when we set up Woodford, we wanted to do things better than we thought the industry, the sort of the standard, if you like, that had been set in the industry. So we wanted to be much more transparent. We said, we're running people's money, they should know what we're doing with their money. So we had full portfolio transparency. And that, I think, was well motivated. All of our investors knew exactly what we were doing in the fund. Every month we gave them a new portfolio update. But of course, when things started to go badly wrong, of course, that was open season to people who wanted to short anything and everything in the fund, which of course they did. It's particularly in anticipation of the sales that were going to come. So I think that was a mistake, and I wouldn't do that again.
You had to remove some of that transparency at some
yes,
stage.
After the suspension, we removed the transparency. But of course, you know, it was the people knew what the portfolio looked like on the day of the suspension. So I think it was a shock to realize what we didn't control as a business.
Yeah.
That was a shock.
Okay.
I think the things that we thought we controlled, we probably didn't. And
Such
we
as?
didn't have control over our destiny, which again would be something, if I were ever to do something like that again, I would make sure that we would structure it differently.
Were there particular things you kind of assumed that you had control of that you realized you
Yeah,
didn't?
there were, yeah.
Can we mention any of them?
The decision after the fund suspension to liquidate the fund, for example.
Sure.
That was not our decision.
Very good. Well, thank you for speaking about that
okay.
to the extent that it is possible at the moment.
I didn't just, sorry, I've been in a very dark place, as you can imagine, but just, I'd heard the previous speakers, I was getting very depressed at the back of the room.
Yeah.
I'm in a much better place now. We've kissed many frogs and decided to move on. We're now in a good place as a small business doing other things, and Woodford Views is just one one aspect of what we're doing now.
Excellent. Okay, well, I'd love to talk a little bit more about that and other things. So Woodford Views has been the most obvious and visible one of those activities. Can you talk a little bit about what it is and your motivation for starting it up?
Yeah, I suppose I have been for many years, probably too long now, frustrated by the consensus narrative on the UK economy. I think we are. A good mate of mine his brother lives in the US, and he was talking about his brother was talking about the difference between just how people in the UK think about their country, how they think about things, and how that's very different from the way that US people think. So, for example, this guy who's playing golf, this English guy was playing golf. He lives and works in the US. He got a fantastic birdie. I'm not a golfer, but he put in great putts, fantastic long putt down the hole. And his American friend said, "Wow, fantastic putt, really great, fantastic." He said, "Yeah, it wasn't bad." Now, therein, I think, in a microcosm is the difference between, I think, maybe the British personality and the American personality, and I see that in many other levels. We're very downbeat about our economy. We're very downbeat about our politics. We're very downbeat about the state of the nation, and I think many of those narratives are just fundamentally wrong. Now, I'm not saying everything's perfect in the UK by any means. It isn't. But it is nowhere near as bad as the consensus would have you believe. In fact, it's much better. And that's part of the motivation. The other thing is that increasingly these days, in the world of social media, anybody who has lots of people have voices who have opinions but no facts. And I think that's a problem. I think there's a cloud of nonsense in social media, and I don't think we're well served in this country by financial journalists particularly. I think there's far too much consensual thinking in consensus in the media, financial media particularly. So I believe that facts and data inform economic debates, and they've informed me all through my career, and I think they can inform a wider audience. And my desire was to try and talk about some of those things, to actually not to be sort of the British optimistic sort of deluded person perspective, but actually to just talk about the facts, the data, and talk about a different type of narrative.
Sure. And I mean, you've built your career on analysing those facts, that data. Are there two parts to this, what you're trying to do to speak about the UK economy in the way you see it? Is there there's an element of we should always see things as they really are, because then we can make informed decisions about them. But is there an element of pride, is there patriotism in what you're doing to an extent as well, or are you just driven by the facts?
Well, I love my country. My parents' generation fought for this country, and that was drilled into me as a young boy. So yeah, I am proud of it, but I don't think that's the agenda here. The agenda is I'm just fed up with reading crap on the UK. I think it's much better than people think.
Sure.
And I'm not quite sure why we are so downbeat about it.
Yeah. Can we unpack some of those reasons now? So, I mean, what are some of the big things that you have observed and sort of deduced to be the case that you think cut against the consensus narrative at the moment?
Well, I think just this idea that the UK economy is in decline. It isn't. If we're in decline, then so is every other European nation and Japan. I mean, the fact is we've outgrown Japan, Italy, France, Germany, many other European countries since 2010. We've outperformed since Brexit, all those countries in growth terms. Real wages have grown, real post-tax wages have grown 1% per annum, real post-tax wages. I know that we're about to enter a political campaign, so I'm not making political points. I'm just saying these are the facts. Real average post-tax earnings in the UK have risen by 1% per annum since 2010. The tax burden on income is much lower now than it was in 2010 for people on average earnings. Now, there are other taxes out there on expenditure, like the air passenger duty and insurance premium tax, other taxes, but the taxes on income, which I think is very important, are lower than they were. This idea that we've never been more taxed than we are now is just factually wrong. It's wrong. The concept that we are so heavily in debt that we're broken, I mean, it's just factually wrong. There's a chart in one of my blogs about how debt to GDP has evolved over time. There have been periods in modern economic history when we've had far more debt to GDP. But when you're talking about debt in this country, for example, I don't want to get sort of bogged down in facts, but when you're talking about debt in this country, you have to look at the government sector and look at the private sector. The private sector has got the household sector, and the corporate sector is different, but the household sector has got £300 billion more in deposits than loans. Now, after the financial crisis, the household sector had 300 billion more debt than deposits. It's a massive transformation. The banking sector has moved, I think, in the UK banking sector has moved 1.3 trillion pounds in effectively towards more liquidity. So more deposits, less loans. So the UK economy, when you look at the UK economy as a whole, you can see, well, there's debt over here in the public sector, but there is virtually no debt over here in the private sector. And so the two, and this is all about the whole balance of winners and losers. Part of the reason that we've got quite an indebted public sector is, of course, that the government spent 200 billion insulating the economy from the worst effects of COVID, 200 billion pounds. Now, part of that was the furlough scheme, which paid 60 billion pounds to people in this country to stay at home and do nothing. Well, and they couldn't spend any money either. So, of course, 60 billion pound was banked. And so you get a very, very narrow, and you can, if you want to be very selective, look at public debt and go, ooh, it's terrible. But then if you look at a more rounded picture of the UK PLC, you get a much more balanced perspective.
And part of your career really has been defined by going against the grain, trying to battle those consensus narratives. Do you think there's a particular reason that you've developed that sort of tendency?
Mostly because the consensus is wrong. I can't remember the last time the consensus was right about anything. It's big. It was wrong about Brexit. It's wrong about the last election. It gets a lot of things wrong. And I think when the consensus is very crowded, as it is now, for example, about the outcome of the election, which was announced yesterday, I think, again, I'm pretty sure the consensus is wrong.
Okay, go on. Let's get into that briefly if we can. So I think, actually, let's have a show of hands in this room. Who believes that it's almost a foregone conclusion, or extremely likely, not to say certain, that Labour will win a majority at the next election? Okay, and who thinks that is actively incorrect? They don't think that's accurate. Very, very small number. Please tell us why the majority of us in this room might not have drawn the right conclusion here.
Okay, so the argument for Labour win is, of course, that the polls are showing Tories at 20%, Labour at 45%, And the Tories have done not a great job recently in terms of PR. They've stumbled into various crises. But actually, in retrospect, without being too sort of critical, I actually think, broadly, I think they did some good things during the two very challenging crises that we've confronted in the last 5 years. I think the furlough scheme was very sensible, and other economies followed our furlough scheme. And I think the government was absolutely right to insulate UK households from the worst effects of the energy price crisis that followed Putin's war in Ukraine. So I think those are big decisions, and I think they got them broadly right. There are other things that I think they got very wrong about COVID, but it was a tough gig. I'm not sure there was no rule book. This is what you do when the world's embarking on a sort of a pandemic. Anyway, so I think it was okay, but broadly, Tories are down at 20, Labour's up at 45. Now, therefore, it's inevitable that there will be a Labour victory at the next election in a few weeks' time. Now, I think polls are wrong, first of all. I think the Tories broadly have been on strike. Tory voters have been on strike in by-elections and in local elections. I think they're pissed off about various things, but I think they will come out at the general election. That's one point. Secondly, we have a very odd voting system in the UK. I believe I'm right here, that Labour have won 45% of the vote on several occasions, and they've won 400 seats and about 270 seats with 45% of the vote. What's important is, where are your votes? Are you winning seats with your votes? Now, at the last election, Labour polled about 10 million votes. Tories vote was 14 million. So for Labour to win the sort of majority that people are talking about as an inevitability, this election, they've got to get broadly 4 million more people to vote Labour. That's a hell of a gig. That hasn't been done before. Indeed, Tony Blair's victory in '97 involved a massive swing from Tories to Labour. What Keir Starmer has to do is to get a much bigger swing than Tony Blair did in '97, just to get parity, not to get more seats. And Tony Blair Labour Party started with 70 more seats than Keir Starmer has now. So I'm not saying they can't win. I'm just saying it's a hell of a thing to do. And if you think Keir Starmer is a Tony Blair character, I think you've got a different opinion from me. I think Tony Blair was charismatic, and I agree that he had a completely new agenda, and people bought into that at a time when they were very disillusioned with the incumbents. I'm not sure that that's what we confront right now.
Sure. And obviously, none of this constitutes financial advice, but what's the trade if the Conservatives do much better than widely expected?
Well, I think most likely outcome actually is a hung parliament, which is not great actually. But I'm quite focused on well, what does it mean? What's the big deal if one or other side wins? Now, of course, at the election in 2019, that was an existential crisis confronting the economy. If Labour had won that election, you wouldn't be here now. I'm not sure I would be. There was a very, very big choice in 2019. And as much as there are things that we may agree or disagree with, essentially, my own view is that Keir Starmer is institutionally much more like Tony Blair than he is the radical left of previous potential leaders or actual leaders of the Labour Party. So I'm not sure there's going to be economically that much difference between the two, actually.
Whoever is in charge of 10 and 11 Downing Street later in July, what do you think they should be doing to get the UK economy moving? I mean, obviously, you believe that the picture is better than many people say it is, but there's no denying there's room for improvement. So what could be the things that would make a difference?
Well, look, I know the narrative is, well, what are you going to do for the economy? And actually, I've always believed that there isn't really that much they could or should do for the economy. The economy is doing just fine. In Q1, the economy grew at 0.6%, okay? If you annualize that, so if we grow it for the next 3 quarters at 0.6%, we will exit the year growing at about 1.5% per annum, a bit more than that, and we'll deliver 2.5% growth next year. We'll be growing faster than the US economy next year, I think. And growth this year is way better than any European peer, okay? So the economy is already moving forward. It's recovering from the legacy effects of COVID, and it's recovering from the energy price crisis. And it is poised to do better, I think. So I wouldn't be surprised if the MPC, the OBR, the OECD, the IMF, they've all been wrong forever, but they are still wrong about the UK economy, and they will be upgrading, but they're not way off. I mean, the MPC had minus 1% for the first quarter this year, and it was plus 0.6. You know, they just don't know. Their models don't work anymore. And partly that's because their models think that when you put interest rates up, that slows the economy. Well, it doesn't, actually. It actually puts more money into consumers' pockets. I can bore you with the detail, but it actually, believe it or not, when interest rates go up in the UK, at an aggregate level, there is more money in household sectors' pocket than less. And that's partly because 86% of the mortgage market is fixed rate, and most of those fixed rate mortgages are 5 years. There is virtually no consumer debt. Well, there's a bit of consumer debt, but it's not, at a macro level, it's irrelevant. And there are £300 billion of deposits, surplus net deposits, if you like. So high interest rates move deposit rates up, which generate, well, since the start of 2021, 31 billion additional interest income on deposits, 13 billion interest income increase on mortgages. That's what's happened in the UK economy since interest rates went up. More money in consumers' pockets. It's sort of, that's why the MPC's model isn't working.
So if the models are wrong and the levers that we have to pull actually sometimes have the opposite effect from their intended consequence, I mean, it sounds like we need to start again.
And I think we will. I think the MPC will be re-engineering their model. The Court of the Bank of England, rightly, in my view, commissioned Ben Bernanke, ex-Fed governor, to come in and have a look at the MPC's model. Last year, Bernanke reported a few weeks ago and basically said, you need to redo that. It's completely wrong. Their model's called Compass, by the way, and it's broken. It's not delivering the right outcomes. So Ben Bernanke thinks it's broken. I think the Court of the Bank of England think it's broken. Maybe they're going to start to, but that will take a while. It's quite a big thing, and they'll take a good amount of time to re-engineer the model. But what it tells me is that I'm not the only one who thinks that the conventional thinking in the MPC, the OBR, etc., is now giving the wrong answer.
Sure. And I mean, if the modelling is better, what are the immediate and tangible consequences of that? How would we benefit?
I think better information about what's going on in the economy will result in better policy decisions. The OBR, the government bases its tax and spending decisions on what the OBR says. The OBR haven't been right about the economy for a long, long time. The MPC's decisions on interest rates are guided by what their model tells them will be happening to the UK economy. That's been wrong. So nobody would invent that system like that, would they? They would say, well, you're in charge of making interest rate decisions, which are important for the economy. You need to have the best possible sort of read on what's going on, and then you can make better informed decisions, OBR and MPC. But unfortunately, they're not making, I don't think the decisions are as good as they can be because the data's wrong and the models are spewing out the wrong answers. Sure. So I think, coming back to what I said earlier on, I'm not sure the government needs to do needs to do too much really to either help or hinder the economy. The economy is just doing okay, actually, and it doesn't need any sort of great sort of structural reform or impetus to start to grow. But from my point of view, I think that there are things that a government could do to guarantee that the economy could continue to grow and would be liberated from the problems that hold it back. And that's largely regulation, I think. If the government actually embarked on deregulating the economy, I'm not talking about a free-for-all for everybody, but we are suffering, all industries are suffering from over-regulation, it seems to me, whether it's the health service, whether it's financial services, whether it's any other industry, there's way too much regulation, and I think we need to rein back on that. That will liberate growth and I think enable us to grow stronger into the future.
It seems unlikely that a Labour government would,
Very
do
unlikely,
that.
yes.
There's one thing I want to come to next, but before we do that, I'll just remind everyone that we do have Slido in operation. It's sli.do.com. If you'd like to put a question to Neil via that platform, we can answer it in a moment. Part of this big system that chucks out the outcomes that influence the share prices and so forth that we worry about, investors of people in the room have worried about for many years, is the makeup of, well, the workings of the LSE, the London Stock Exchange, the makeup of the FTSE 100, this whole picture. It's been picked up recently and talked about as something that's failing, that's broken. We've seen some major listings that could have happened in London gone to New York, although there has been a bit of bright news recently with Raspberry Pi and Shein sort of talking about London. What's your picture of the situation as it stands, and why does it matter?
That's a big question. I don't want to bore you all. I have written about this, by the way, on the blog. But anyway, it's a big question. Okay, so the UK stock market is not the UK economy. That's an important point to remember. Only 15% of the UK stock market really reflects what's happening actually here in the UK. Only 15. 85% is really about the rest of the world. It's a very international index, but it has underperformed dramatically for the best part of 2 decades. And that underperformance is, in my view, the direct product of 2 major, possibly 3 events. The 2 that I would obsess about are really regulatory reform. One was with respect to pensions accounting, which was introduced in the noughties, but had been talked about for about 4 or 5 years before that. Basically, pension accounting rule changes brought onto PLC balance sheets all their pension assets and liabilities, all their defined benefit pension assets and liabilities. And that caused something that everybody that I knew at the time said was inevitable, which would be that all the DB pension schemes would sell their UK equities. They were the biggest owners of the UK equity market, and when the biggest owner of a particular asset is a seller, and the seller down to naught, that's a hell of a headwind for any market to have endured, and that's exactly what we've endured in the UK for the last 20 years. So that was one of the problems. The second problem was MiFID II, which was a disaster, and that undermined the structure of one of the structures of the UK equity market. So as a result of those 2 problems, we have major headwinds in the UK, which have resulted in people taking money away, not allocating to the UK. They look at the performance of the UK equity market and think there must be something inherently wrong with the UK economy or something inherently wrong with UK PLC. There isn't. It's just the product of a massive seller, basically relentlessly valuation insensitive selling of the UK equity asset class. And that's been a massive headwind for a long period of time. But that's left scars in the UK market. The UK market now struggles because the inherent relationship that I witnessed, as a fund manager for so many years, the relationship between companies, brokers, fund managers, that was a sort of symbiotic relationship that nurtured long-term patient capital investor. Not everybody was a long-term patient capital investor at all, but it was designed to create that sort of long-term patient capital ownership-ish in the UK. So brokers were paid retainers by companies to represent them to institutions like me. Those brokers had high-quality analysts that would write really good research. They would present that research to me, people like me, and we would read that research and think, that's really interesting. I really like the idea of that company. I'll go to that broker, set up a meeting with the company, go and meet the company, really like the CEO, like the company, like the strategy, invest in the company, build a relationship with the company through the broker. And you can see why that created a sort of a symbiotic relationship between institutional investors, brokers, and quoted companies. MiFID II came along after the damage that was done by the pension reform and really broke that relationship in pieces because it didn't allow fund managers to remunerate brokers for providing them with research on companies. I'm simplifying it, but they changed the rules to make it
for free. Is that?
What they said is you can't pay brokers through commissions.
Right.
You have to pay them with hard cash. And institutions, well, we've paid them commissions for years. I'm not. How do you? What's that piece of research worth? I don't know how to value it.
Yeah.
I've never had to value it, but now I've got to value it. What am I going to pay you? And in the end, they actually ended up not really paying them. And in the end, bank brokers, particularly the London brokers, decided, well, then we'll just give our research away for nothing. And of course, if something's free, people don't value it. And also, as a result of the fact that brokers weren't earning money from selling research, they couldn't afford to employ the really expensive high-quality analysts. So all the high-quality people were drained out of the system. Okay. Brokers couldn't get paid for the research. Companies couldn't, the fund managers couldn't get access to the research, and so it just broke this relationship down. And if you break the relationship down, then you don't get long-term patient capital investing. You don't get active fund management. You get passive, I'll just buy the index. Yep. And that's a problem, because if you've just got index owners of the asset class, how does a company come to a market? If I'm a CEO of a company and I want to come to the London market, for months before I actually IPO my shares, I've got to cultivate a following. I've got to convince enough brokers to, yeah, we'll support your IPO, and we'll go out to our institutions and we'll go and talk to them about your business, and you can have loads of meetings, and you can talk to the investors about how brilliant your business is, and then they'll want to invest in you. But you can't do that, and these investors can't buy your shares or can't commit to buying your shares because they've got an index portfolio, and you're not in the index, so they're not going to buy you.
But I mean, index investing has thrived in recent years and has proved very popular. I mean, it's not going anywhere, is it? Or maybe it is.
Well, no. I think there's a place for index fund management, but equally there's also a place for active fund management, because you need to retain active fund management in any marketplace to ensure that companies can do what I've just described. Yeah. Asset allocation is an important sort of role of the stock market, and that becomes a problem in a totally passive world. Sure. So,
can we talk a little bit briefly about what a better UK ecosystem would look like in terms of the stock exchange and the companies that are listed? What would have to change in order to make it better? Or, in fact, are some of the changes that we've seen kind of starting to move the dial?
Yeah, so I think there are things that can change. By the way, the problems that the UK equity market confronts won't stop the UK equity market from going up. I think the UK equity market has started a mean reversion right now. It's been underperforming for 20 years for the reasons I've just talked about, and those reasons have now gone away largely. The selling has come to an end. They can't sell again. They've already sold out the UK equity market. So what you now have is an absence of sellers and a gradually, sort of, I think, a healthy, slightly increasing balance of buyers. And I think the UK equity market has already shown signs this year of beginning to break out of this long decline that it's had for 20 years. So I think the market can rise to a much higher level and a much higher valuation and a much more normal valuation, despite the problems that I've just talked about. But if I were in government, I'd want to get the UK back to where it should be as a thriving market, which attracts companies who want to list on it, where companies can raise capital, and where the process of recycling capital from mature businesses to young technology businesses is sort of alive and kicking. That's what I want to do. And to do that, I think you'd have to get rid of that element of MiFID II, just completely bin it and go back to where we were.
Would you require pension funds to invest in UK equities?
Well, I would, actually, yeah. And people think that, some people, I've read some opinions about this, and they think it's a dreadful thing to say. But the fact is that DB pension schemes, when they sold UK equities, they hung on to their international equities, they hung on to their PE portfolios, they hung on to their hedge fund portfolios broadly, They have diminished them. But at the moment, DB pension schemes still own those non-bond assets in their portfolios. Now, at the same time, of course, UK pension funds, or effectively the beneficiaries of the UK pension funds, DB pension funds, are getting huge tax benefits from the Exchequer, which we all pay for. So I don't think it's a fair contract. I think if you're a DB pension scheme and your pensioners are benefiting from tax benefits provided by the state, then you should have a responsibility to invest in your home market. So I think they should do. And if I was, I'm not saying that they should sell down their gilt portfolio, but I think they should sell down their international equity portfolio to buy. They should be mandated to buy domestic assets. So I would do that. I would get rid of that MiFID II measure. I would get rid of stamp duty on purchases. I would ban short selling on anything outside of the FTSE 100.
Okay.
Yep. And what else would I do? I would set up a seeded sovereign wealth fund.
Okay. Well, that's a pretty good manifesto in quite a short order. I'm going to come now to some of the questions that we've kindly had sent in by the members of the audience here. An interesting question here. Neil, I like your optimism around UK PLC, but how bad would it need to get to force you and your family to become non-resident, and where would you go? Would you consider this?
My colleagues actually all live in Dubai, so I'm the holdout here in the UK. I think I should be buried in this country somewhere. I'm staying, sort of, despite the headwinds, really, and despite every reason to sort of stick my fingers up at slightly unpleasant way of putting it, but anyway, sort of the UK establishment. I love this country and will stay here despite the weather.
And I mean, this is a slightly unfair question because, you know, arguably you are a star fund manager. You've certainly been recognised as a star fund manager during your career. But do you think there is such a thing? Does the concept make sense?
It's hard now, really hard. If in a parallel universe, if I was still, if what had happened to Woodford hadn't happened, and I was still managing money now for retail investors and institutions, I think it would be very hard to do the things that I was doing in my career. Very hard.
And a good but simple question is, what's the best piece of advice you've ever been given? Someone wants to know that.
Blimey. God, I've learned so many lessons in my life. It's hard to pick out any one thing, really. I can't really answer that, unfortunately. It would be, I'd be fibbing if I said this, you know, something stands out.
Yes.
There are lots of things, I think, that stand out in my life.
Before we run completely out of time, I just want to ask a question about spotting good and effective companies, which I guess is part of what you're doing now. Something you've written previously led me to believe you thought there was a difference between what made a small private company successful and what makes a big public company successful. Obviously, they work in different ways, but is there something that you're looking for as an investor, or you have looked at as an investor in the past, in each of those two different cases to identify the businesses that have what it takes to be successful in the future?
Yeah, I think good leadership is common between two. So you need some of the best big company investments I've made have been in businesses that have been led by outstanding CEOs that have stayed at the business for a long period of time. I think Warren Buffett once said, you know, that great company, bad management, company wins. Bad company, great management, company wins. So you might argue even great corporate captains can't turn around fundamentally bad businesses. But the trouble, the only argument I would have with Mr. Buffett is that sometimes the valuation of those bad companies is so low that a good leadership, a good leader can transform the prospects of an also ran. But for smaller businesses, really, I think you've got to have that great leadership. But I think you've almost got to focus in on what the company does. Is it unique? Is it differentiated? Does it bestow competitive advantage? Is that competitive advantage sustainable? It's building businesses from the ground is really, really, really tough. Getting capital is really, really, really tough. And so you've got to be convinced that the company's got all of those, or at least those things are obtainable or achievable for a small business that is ambitious to grow and succeed. So yeah, you do have to have good leadership though in both good groups.
Thank you. And final question, a bit of future gazing. What is the single biggest factor that will influence the markets, the economy, the sorts of forces that we have to worry about as investors or people's clients have to worry about?
Okay, so barring future pandemics or conflagrations, which I think we've had our fair share in the last 5 years. I think I'm not sure that we're going to. I'm struggling to see where the next. Maybe it's China and Taiwan, but I'm not sure really. So I think there's a lot of saber rattling going on over there. But anyway, I'm hoping that doesn't boil over at any stage in the future. I'm pretty sure it won't. But that aside, geopolitics aside, for me, the lesson that I would, or if I was coaching my son, who's only 11, but if I was talking to him about investment, I would emphasize the V word, valuation. Too many times people just lose sight of valuation, and I think for good reason, because valuation sometimes is historically it's not been a good guide to short-term share price performance, either from markets or from individual companies. But what's required is patience. So a combination of patience and valuation are very, very, very compelling, a very compelling cocktail of things to focus on if you're trying to build wealth over the long term.
Neil Woodford, thank you very much indeed. Thank you for joining us.
Pleasure. Thank you.
Cheers. Thank you. Thank you very much.
Thanks very much.
Thank you. Cheers. Thank you.